Good morning, everyone. Welcome to
Ryan.
ECB Day. Good morning, Kay.
How's life treating you?
Yeah, all good, mate. Been busy this morning trying to get ready for today. Lots of prep going in. I thought I'd start early, and I was still rushing to get finished by the time the show started. You?
Yeah, we're all good. We're all good. I'm watching you, man. I don't have to prepare anything.
Oh, left it all to me. See, you're getting the homework for the next central bank meeting. You're on the Bank of Japan.
Okay.
Right. Well. Oh, hang on. Let me just shut off my live squawk. There we go. Don't want to be listening to that in the middle. Yeah, welcome everyone. Hi, Paul. Adam, joined the funding program today. Very best of luck to you, my friend. As you know, you'll get access to the ForexAnalytix platform, so please feel free to drop in. We've got a dedicated chat room there for you guys, or discussion there for you guys in the funding program. If you do have any questions or want any advice, please feel free to drop us a line in there, and one of us or someone in the community, or lots of people in the community, will be there to help you out and answer your questions. But good luck on the program. I wish you best of luck, and hope you smash it out of the park, mate. Jordan, hi there. Bran, old mate Bran, good morning to you. Arif, thinking about the program as well. Again, same advice. If you have any questions about this, everyone's there to answer those for you. We want to make sure that this program is right for you guys, and that you understand the rules and the basics behind it. We're not just trying to, wedge people in, as many as possible. It's not a money making scheme just to get loads of people through the door. We want you guys and girls to succeed, and as I was saying yesterday, we want you to come out of the 60 to 70% of traders that lose money regularly. We want to put you in the 20 to 30 who make money, and this program will go a long way, hopefully, to helping you achieve that. It is very disciplined, extremely disciplined, I would say, but that's good for a reason, because hopefully it gives you the best foundation for them to move on with. You've got to have a starting point in this game, and discipline is the key part of it. So good luck with that, Arif, if you decide to take it on. Hopefully you'll make it work. Right, so obviously lots to talk about today. The ECB, obviously the main subject, so we'll get through some of the headlines. Not a lot really that have been going on. One of the main stories, probably, or developing stories at the moment, is that Shanghai have possibly heading towards further lockdowns. We heard that there was a couple of districts or areas that were undergoing testing or had seen cases, but it's just popped up on the news wires that there's now going to be 7 districts undertaking mass testing this weekend, Saturday and Sunday. Now, Shanghai is obviously a big deal in terms of its location as a port for things like that, and so the fact that they were heading out of lockdowns and restrictions and now potentially might be heading back into them is not going to be good news, potentially for risk, for supply chains and everything that goes with it. It's not a definite that they're all going to go into lockdowns. They're still apparently going to be opening their big Disney resort there. But this is going to be some news that we may have to wait for over the weekend to see if the situation deteriorates once again. Moving over to the US, we had another crappy NBA, sorry. Let's get the calendar out. The NBA came in down again. It's continually trending down now. This has been going on for several months. Mortgage applications down 6.5%. The purchase index dropping, the refi index dropping, the market index as a whole dropping. Now, as you guys and girls who are in our chat room and have been following the Flow Show, this has been a data point that we've been watching I watch all the time. And we've been highlighting for several months now that we could be seeing the housing data or the housing sector starting to turn a bit negative. We saw that with the raft of main data that we got from the US this month. All the indexes and markets were down there. So it's continuing, and it's looking like it's going to continue, and it just depends how bad it's going to get. I'm not predicting that anything's going to be crashing or anything like that, but it's one sector that is heading south. You know, if all the other sectors start going the same way, manufacturing, retail, consumer, that sort of thing, then the pressure is going to pile up on the Fed and their rate path. I am seeing now a lot of wider analysis on this, a lot of after the event analysis that, you know, there were signals in December and signals in January. It's funny how some of these people were piping up, you know, 4 or 5 months later to tell us what was happening 6 months ago, while we've been telling you guys and girls all the way through this. So it's, as I mentioned, particularly for me, trading the fundamentals, I look at these little signals because it gives you advance warning, or can give you advance warning of problems to come. If you know that, and if you can get in ahead of everyone else, it can give you an opportunity to get in some trades, to get out some trades if need be, because you can sense that there's something changing in the economy. But anyway, something to keep an eye on, and lots more water to go under the bridge there. Over to Australia, and another funny thing happening. We're getting now Australian banks calling for RBA rate cuts in 2023, which I find absolutely hilarious. They were all pretty much towing the RBA's line of 2024 hikes some time ago, and now 2 hikes in to their hike cycle, and the banks are now calling for cuts coming next year. So that potentially means that if the greater market sees that coming, it could put a stymie on the Aussie dollar, and you could find that we start to see the Aussie dollar coming lower. This is potentially something that might snowball. As I say, it needs to be taken up in the wider market if they expect that. What the market will be looking at, again, like we are for other central banks, is where does the RBA see its neutral rate? You know, what level? 2%, 2.5%, 3%? Are they going to look to go above their expected neutral rate to combat inflation and then bring the rate back down again? But they're in the same position as everyone else. They're hiking into potential weakness, or the hikes may create potential weakness. So how far they're going to take those hikes? So from a trading perspective, you know, it's, if this is picked up in the wider market, then, you know, we could find that Aussie dollar from the Aussie side is going to struggle to rise significantly. And if it does rise significantly, it's probably going to be on the back of some dollar weakness, US dollar weakness, or something changing there. So that's it really from the headlines and news. Not a lot of data out today. Kay, I don't know if you got any headlines that you've picked up.
No. There was very little out in the headline, in the, let's say, the market moving headlines. Yeah, very little out.
Yeah, not a lot. So a quick look at the options today, and obviously the euro is expiries are going to be the ones to watch. We've got a few yards up and down the price ladder, but for an event that's potentially as big as this, there's not really much size about. And one of the guys in our room was actually looking at the options pricing, and it seems a pretty flat affair as far as pricing goes. You know, people hedging the potential risks from this. So doesn't seem to be that much positioning, at least on the hedging side, going into this event, which conversely can create a bit of volatility if traders and players are forced to play some catch up. You know, maybe if they've underestimated the news to come, that will add to the volatility we could see in the price moves here. Now, what I'm also going to pick up, let's get rid of that one.
Ryan, regarding those options, maybe we can have a look in tomorrow, so to see what's happening after the whole raft of central banks. Perhaps we are going to see a bit more people trying to put on structures or protection against the whole shebangs on the CPs, which would be next week Friday or so. Might be bigger. Just a thought.
Yeah, definitely, mate. Yeah, I mean, I had to look at the. Let's pull it up quickly, give you guys a little bit of insight. If I can remember, I've saved it. I did look at dollar yen yesterday.
Very light.
The expiries for pretty much out for the next 3 months, and you know, there's really not a lot. 135 is the big expiry area, but there's really not a lot above. I can't find the
No, but we could see bigger barriers up there. And
yeah, that's right.
I'm thinking not only from our buy players, but the Japanese corporates as well might be lining up there. Some of them have protections built in, linked to barriers for returns or for protection of their FX ranges, but they usually put barriers onto it to make the premium cheaper.
Yeah,
and that's a risk that we are running to see higher up 135 and perhaps even higher.
Yeah, so that chart I've just put up there, that's all the expiries per strike between yesterday and the end of September, so roughly a 3-month window. And as you can see, 135 there is the biggest on the upside, just over 6 million, 6.4 billion, I think, which isn't a huge amount, but I found that dollar yen expiries have been, the options market has been a bit lacking the last few months. Normally you'd expect to see, on a weekly basis, some of the expiries 5-6 billion in total for the week. So to have just over 6 billion over 3 months doesn't suggest there's an awful lot going on. But as Kay says, we've heard about potential barriers at 135. They were at 134, 134.50. 135 is going to be a big level. It's a big technical level, and it's the next big option level. So lots going on there if we do manage to get up there. So that's just a bit of insight on that one. Coming back to the ECB now. So we're going to take a look at that. Let me just get up something else I wanted to show you guys. Where are we? Give me a second. Right, so looking at the some of the metrics that I look at, if we talk about how we set up to trade, look at the things that we expect, there's various stages of analysis that I personally do. The first of which is to look at which way the market is leaning. What is the market expecting today? So if we look at this pricing from the Euro STR and the OIS market overnight index swaps, they've got a pricing there of 66% for a 10 pip hike today. Now that doesn't mean really that they're expecting a hike today, but the pricing is gearing up for a change in tone from the ECB to potentially turn more hawkish. If we look at the implied rate there, it's still sitting at 0.51. We know the deposit rate is minus 0.5, so it's sitting there at minus 0.51. If we jump to July, that's when we can see the hike, a 25 pip hike in the pricing there, because it's jumping from minus 0.5 to minus 0.25. And then into September, we've got more or less a 50 pip hike. So that, in terms of market pricing, that's what the market's seeing. And there's other metrics you can use. I'm sure you'll heard the headlines popping up, money markets pricing, XYZ. Well, they've shifted up their hike expectations for the ECB. They're now, I don't know what the latest is, but as of yesterday, they were pricing 75 pips of hike into September. So all this is telling me that the market is potentially leaning a bit to the hawkish side. We do have the baseline, and I'll bring up my cheat sheet for today, which I scribbled over last night for you guys and girls. So if we look at this, the baseline really is what we've got in the middle. So confirming the end of QE, the beginning of July, potentially setting up 2 25 pip deposit rate hikes, July and September, maybe some talk on further 25 pip hikes into the end of the year, 2023, the usual data dependency, etc. But what I'm thinking, looking at this pricing from the OIS and from money markets, is that perhaps the market is leaning a bit more hawkish than the baseline. Now, why that's important to me is because the second thing I do is look at where the big price risk is. Where is the biggest risk of today's event? And if a lot of the market is leaning more hawkish, the bigger price risk is they get disappointed. So, for example, you're more likely to see the euro drop harder on disappointment than it may rise if the market's right, because the market's leaning that way already. It's leaning more hawkish. So potentially the upside may not be as big as if the ECB disappoint and the market comes off. So from that, I like to have that bias going into an event like this, because then I know where the greatest risk potentially is. That can affect my trading and how I set up. If it was the other way, if the market was leaning very dovish, the bigger price risk was that the ECB are hawkish. So the upside has potentially greater potential than the downside. But anyway, so we've got the baseline. That's the middle of the road, if you like. If we get a hawkish outcome, the next level up in the hawk scale, confirming the end of QE, sets up these 2 deposit rate hikes, but the 50 BPs are there or thereabouts in the table, whether it's for 1 or 2 or whatever. 50 basis point hikes are on the table. And to get into something that's maybe super hawkish, again, end of QE, setting up the deposit rate hikes, but at least 2, and some of those can be maybe being 50 BPs, carrying on through the year into 2023, but also talking about perhaps main rate hikes, because as we know, their main rate is at 0 and it's the deposit rate that's at negative. So there's 2 rates that we need to watch when we're looking at the ECB. One's at 0 and then this deposit rate. Everyone's really focusing on the deposit rate, getting that up to 0 or getting that positive, but the main rate could potentially be a consideration. That'll take it, any talk on that will take it into the super hawkish zone. And on the other side, if I know people like to call it dovish if the ECB disappoints. It's not really dovish in my book. It's less hawkish. I call it unhawkish. The first rung down from the baseline would be confirming the end of QE, mentioning the possibility of 1 or 2 hikes, maybe 1 definitely for July, but won't. And they use this language a lot, pre-commit to the second. And making 50 pips hikes a distant possibility. That'll be less hawkish because they're not really committing to anything. They're not setting anything out in stone. They're going to leave it a bit wishy-washy, data dependent, forecasts, that sort of thing. And then taking it down to really uber and hawkish. QE is a done deal. Let's get out the window. The end of QE is a done deal. They've told us as much. But then if they don't cement or really confirm a definite July hike, and if they don't commit or even give us insight into the future path for rates down the line, that's going to be really gnarly for the euro. That's going to hit the market hard, and we're going to see the euro dump on that. Now, obviously, with something like this, you can't cover every single item of language, possibility, numeration that might go on. So I've just sort of chucked in some added extras of what might get mentioned and the other things to look out for. On the hawkish side, if we get some hard comments on QT plans, reducing the balance sheet, maybe mentioning a high neutral rate. If they set a path for rates and they say, right, we expect to hit neutral at 2.5%, 3%, whatever it might be. If it's fairly high compared to what the market might be thinking, that's going to be bullish for the euro. On the other side, we probably will get this comment that they'll stand ready to reduce rates or start QE again if needed, but you wouldn't expect to hear that strongly at this meeting, where they're potentially looking to get onto a hike path. So that keeping that sort of language in there might be seen, pretty dovish. And then if they're going to monitor the effects of rate hikes before deciding to hike again, that puts it on the unhawkish side, even on the dovish side, because they're going to take a slow approach to raising rates. And then perhaps maybe they mention a low neutral rate. Maybe they have an idea of 1.5%, 2%, something like that. That'll be a bit of a disappointment to the market. Now, we've also got some unknowns in there. We know that they've been looking at a fragmentation spread control tool. This is something they've spoken about because if they do enter on a hike path, they do change monetary policy, and if we start to see inflation hitting in different ways, they want to keep yields in control. So they don't want, for example, Greece blowing out against Germany and things like that, or any other things that pop up, another pandemic or something like that. So it's almost keeping an idea of QE on the table, if you like. We don't know exactly what this control tool will be, so we're going to be looking out for comments on that. I'm not sure if it's going to be dovish or hawkish, this control tool, because if they need to buy bonds to control yields, that's dovish because it's almost like doing more QE. But if they have to sell bonds to control yields, that's almost like QT, balance sheet tightening, because they'll be selling their holdings, which usually is seen as hawkish. But I think overall, this tool, if it sounds right, if it's there as a protection to stop anything negative happening, then that might be seen overall as euro positive. And then we've got what I call the usual waffle. As I said before, they're going to put the comments in there, stand ready to act in either direction based on the economy. Everything is data dependent. They'll kick some stuff maybe to the next projections, which will be in September, I think, before confirming future monetary policy changes. And they'll be monitoring financial and price stability as always. So that's my cheat sheet there. K-Man, you got anything you want to add to that?
We're basically focusing on a couple of things, as you said, whether she leaves. What we also were talking about is that, but we'll come to that probably a bit later, is that we could have one reaction on the statement and then another reaction when she starts her presser. We have to remind us all the time that Lagarde is a lawyer, so she has the ability to surprise or to kill every too high expectation. On this fragmentation tool, I think it's very hard to know whether this one is really positive. It had been understood for a very little while as positive when they started to come out with it, because spread widening, let's call it south versus the core Europe or the north of Europe, which is mainly Germany, bit of France, Netherlands, and Austria. And then on the other side, you got Italy, Spain, Portugal, and Greece mainly. The spread control should be as such a bit positive euro, because they probably, if they want to control the spread, they will be buying Italian, Greek bonds, but at the same time selling German and French also bonds. So yeah, that is positive as such on euro from a mechanical point of view. But when psychologically for investors, if they start to need to use this fragmentation tool, it also means that there is an issue. So yeah. I think it might be short-term positive, and then in the longer term, the investors might say, like, hang on a minute, this is not really positive for the euro as such. And also, in theory, they will keep the amount of bonds neutral, right? You're going to buy one and sell the other one, or vice versa. So it's tough to know whether this fragmentation tool is really positive or negative. For the rest, yes, I'll be listening to her, especially because she was the one pushing back against the hawks. But it seems lately she's letting the hawks do their thing.
While turning hawkish herself.
Yeah, just listening whether she leaves the door open to 50 BPs once or more. As you pointed out, the market pricing, there is a pricing for at least 150, and some are trying to say that we might have 250s into year end. She will be grilled on that one, and I'm curious to know what she will say about it.
Yeah, you've raised a couple of good points there. I think on the fragmentation tool, I think you're right. I think it's likely to be euro positive in the first instance that they're putting in that protection, but it'll turn negative if we get into a situation where they're forced to use it. But that's two different time frames to look at. And as far as Lagarde, this is why this meeting is such a big one, because she and the ECB in general, Draghi's done it. They like to take the volatility out of these meetings. They also don't like to go too far. They like to leave a few crumbs on the table for you without leaving the whole loaf, if you like. So, when you look at all the prior meetings that we've had, it's hard to see Lagarde suddenly turning into, a super hawk like Powell did.
Yeah.
But it really depends on how her and the rest of the governing council view the inflation risks, view their policies as it's been at the moment, and whether they need to change harder and faster than they had before. I mean, Lagarde really changed in the course of a couple of days. She started trotting out the line, expect to end QE at the end of Q3 or at Q3, and then hike maybe some weeks later, some months later. And then a few days later, she joined the Hawks and was saying, well, now we expect a hike pretty closely after finishing QE. It's those changes that swing it around. But is she going to carry on growing hawkish, or is that her line? And, she's potentially going to disappoint the market. We can sit here and talk all day about the possible permutations. At the end of the day, we've got to look at how we trade it.
Ryan.
Yeah, go on, mate.
Yeah, can I just add one little point? And that's a really very, very low probability. But we have seen Villeroy in the past making comments that low euro is counterproductive to fight inflation. We should not attach too much probability to it. But if ever she would say that yes, the low euro is counterproductive in our combat against inflation, that would really put the fire on under the rocket for the euro, right? But I attach a very, very low probability to it, because up to now she's been saying, oh yes, we saw the euro, and that's it. If she would change tone there, that would be a massive change.
Yeah. And then we wait for 119, because that's when the ECB always comment on the euro.
Yeah.
When it gets to 119. Right. So as I said, we can talk the different permutations of the ECB and what might happen till the cows come home. But at the end of the day, we've got to work out how to trade it. So I'm just going to give you a bit of insight how I set up for things like this. And it really is a case of just going over the charts, plotting the levels, and for me it becomes just a situation of, right, if a certain circumstance happens, the price is going to do something. So what is the price going to do? And almost just as important, what can't it do? So if we get a hawkish ECB, I've got some various levels, and I plotted these up in the chat room earlier. Obviously we've got this fib, and we've got these recent highs here around 107.86 into 108. Okay, we're pretty close here. So any big news, that's going to get blown through pretty quickly. It's not really going to stand a chance. So then it becomes, on the top side, where can it go? Now, I'm not going to sit here and say, okay, this is going to go to 112, because there's tons of stuff in the way before it gets up there. So what I do is I look at what comes out. I look at the comments, the news, whatever, the statement, see what the market does. And then I watch the price. Can it break through this next zone? I've got 108.30, 70. Now, this is a big old time zone. I've traded it before, traded it in 2016. It's one of those zones where you've had a lot of historical price action. It can be one of those zones where if you're trading it and you're there every day, it becomes wishy-washy. But when you've been away from a level for quite some time and you come back, you tend to see these areas show up again. Now, again, on big hawkish news, we'd probably see this level taken out because, you know, we're only what 115, 140 pips away from it. But then you look at the levels and you think, right, what has the price got to do? If this is really bullish, if this is really hawkish, the levels have got to get broken. And if you see some of these bigger levels get broken, let's say, for example, we get through this 108.30, 70 zone, we're going to be getting into some heavy traffic in the sort of 109.20, 40 area. We've got another fib there. We've got the prior resistance that we had when we had the breakdown back in April. You know, we've got the 100 DMA up there too. You know, the tech levels, the confluence is stacking up. This makes it a level to watch. So if the price gets up there and it can't get through, then you've got a question to ask. You know, is this going to be a potential top? Is this where the price is going to hold? What's going to happen here? And from that, you can start to make your trading decisions. Now, the difficulty for a lot of people is that if you're not positioned already into this, and I'm long euro dollar down in the 104s, I'm long euro sterling from 83. If you're not positioning in before the event, you can get a bit FOMO in wanting to pick a side, have a guess of what you think is going to happen. And the thing is, you don't want to get called out. You don't want to get whipped out, you know, in some extreme price moves because the statement comes out at 12.45. Euro makes a move. You think happy days because you bought into it. Then the market stalls. Then we get the press conference. Then we get some less hawkish comments, and bang, you're knocked offside again. So if you're not positioned already into this, then you need to look at these break levels and look at either side. So plot your levels on the upside where the price might run into trouble, and look for the confirmation of the breaks. You know, if we break above, say, this 108 handle, run up to maybe near 109, can't hold it. If we come back down again to the break point here around 108, if you see support there, if the news is hawkish, but the market's dipped a bit, that's where you're going to be looking to get a trade long. Look for the confirmations of the breaks. Conversely, there's money to be made looking for the stretch points. As I say, let's say we get a run up to this 109, 20, 40 zone. The price bangs its head, bumps its head for a while. The news gets digested. Time passes through the day. You know, we get through the end of the press conference. There's nothing more added to the fire. No more fuel on the fire. Then potentially you've got a reason to have a look at the little short. Take it in the context of what the ECB is doing. If the ECB has turned hawkish, you know, the path of least resistance is up. So if you're going to be shorting a spike, you're going to you need to keep your risk tight because you're potentially trading against the wind. But it's the levels that will tell us this, both sides, up and down. So I've got some levels on the downside, nothing much in the middle here, 106.35, you know, 70 odd pips away from that, 80 odd pips away from that. May not stand up if we get some less than hawkish news or disappointing news. Then I'll be looking potentially the mid 105s, maybe even down to the big 105 below. But one thing I also want to add when looking at the levels, even when you've done your analysis of levels, even if you've got some big strong levels that we're close to into the event and they get busted, don't ignore them. Just because it gets busted in the short term because it's pretty close doesn't mean it won't turn into a level on the way back down on a retest or something like that. So don't ignore the levels even if they get broken, especially if we come back down to those sorts of levels. And the third thing I want to mention as well, which is a bit of a risk for the ECB meeting, because we get a bit of time between the announcement and the press conference, it's easy to get sucked into that area because, as I say, you know, get some hawkish comments in the statement, the euro bounces. What the market tends to do is then, as I say, stall a bit into the press conference because there's a risk there for anyone who's been buying on the announcement. There's a risk there that the guard says something that's not in the statement that could send it back down again. And so what the market does, it can gyrate during the press conference, and if she starts answering questions along the same lines as a statement, or she's a bit more hawkish, then maybe we get another move up. but you still potentially find some hesitation, because what the market does is it wants to wait for the press conference to be over before potentially making its final move. And I call that the second wind. So you can get a period where the market's thinking, right, we need to watch the press conference just in case something different comes out that changes why we're suddenly all long the euro and all piling into longs. But once it gets over that hump, we can often see a second wind effect. So don't be thinking that you've got a top. Let's say we get a price spike. Don't potentially think you've got a top in play just because it's not moving again while the press conference is on. Let the press conference finish, give it 5-10 minutes, see what the market wants to do. If it's sitting up against a big level and it can't break it after 10, 20, 30 an hour after the press conference, well, then you've potentially got a top in play. And the same on the downside. If we get negative news, look at the levels. If we're bouncing off a support level, the press conference finishes, we don't break that level, it bumbles around a bit, then you might have some conviction that we found a bottom. So that's how I look at it. In terms of my trading, as I said, I'm long already, so I've got some chips on the table. So I'm not too interested in rushing into anything on the announcement, or I don't need to rush into anything. Obviously, I'll play it by ear if I see some big news I think is really hawkish or whatever, and I can manage to grab a quick trade, I'll do so. Other than that, I'll just be managing the positions I've got and seeing what the whole thing press conference leads to. The only place I'm really potentially going to drop a couple of break orders is in euro sterling. Sorry, Kay, did you want to add anything on euro dollar before I switch over?
No. I mean, I'm watching the same levels: 106.30, 108. I'm a little wider, perhaps 108 figure 35, because there's like levels that held and broke and then held again. That famous trend line. We're watching the same 200 points range to see if it breaks and holds. And as we already said before, be careful between the statement and Lagarde later on. Now, she has the potential to kill a lot of hopes. Or if she turns hawkish, that would actually be the real surprise. If she turns hawkish, then I think it's 110 before the end of the day, right?
Yeah, well, I think 110 might be a bit of a push, but I won't get past it. We shall see.
I don't think so. But yeah, I basically agree. I don't have any position right now on the euro, but it's a big enough meeting to plan for some.
Yeah. So as I was saying, euro sterling is one. I feel more conviction for playing euro sterling on the ECB, particularly because it's against the BOE rather than playing euro dollar against the Fed. That's one of the main reasons I'm long this pair, because if the ECB do turn hawkish, it's going to potentially swamp what the Bank of England do by pure size. ECB is by far the bigger bank. Lots of, the euro is by far the bigger currency. So by sheer size, you're likely to get bigger bang for your buck trading the euro versus something like the pound, or maybe against some of the other crosses like the yen. Obviously, we got the Bank of Japan standing pat. So it's what I look for is where am I going to get potentially best value for my money? More pips for my buck, if you like. So we've got this big 86 level, as you know. I've been banging on about it for long enough. So this one, I'm potentially going to drop some buy stops in just above the 86 handle, maybe 15, 20, something like that, just to catch a break. Play it as a short-term trade. Keep a tight stop on it, maybe 25, 30, 40 pips. Look to see if it does spike high. If I get that spike high, take a bit of profit, maybe again 25, 30, 40 pips if I see it. Knock out some of the trade there, put some in the bank, and then potentially look to fold the rest into my core longs and see where it goes from there. But you've also, if you don't want to go with something like a buy stop, which can be good in normal times, because it leaves you putting in a trade above the market. So if the market doesn't get there, you don't get in. It's not like buying it now and hoping 86 breaks. You're doing it when 86 is breaking, and you're risking your money up there rather than guessing below. But there is an additional risk, obviously, around a big event like this, because you can get some pretty wild price moves. It might spike up initially on one piece of information in the statement, trigger your entry, and then another line that they read 5 seconds later is more dovish or less hawkish, and bang, it's back under again and your stop's tripped out. So I'll keep my risk manageable, keep it more to a short-term trade, so I'm not going out on a limb. But if I do get a runner, then I'll look to ride that horse as far as it goes, take some money, and fold the rest into my long-term position, stick it in the bottom drawer and see where it goes. So levels-wise, again, on the top side, got this big 86 level, the fib that we've got here. The next area is another zone, pretty much 60, 70. It was, again, prior highs after a breakdown. Looking back, you can see it's had significance going all the way back, 2021, 2020, even further back, 2019. So it's just one of those areas, again, that has been a historical traffic zone. I mark it up there because it might be one again. And from where we are now, 100 pips away, you might be getting into the sort of range where that might become a stretch point. Failing that, we've got the 50 fib of this big move up in the 87s. Again, it's another resistance zone after a break. So on its own, without the fib, again, it's another technical level to look at. And above there, it's a bit of a gap up to sort of the high 87s, near 88s. On the downside, now I've stripped out quite a few of my levels on the charts, both here and in Eurodollar, because I want a clearer picture of what I'm looking at. So sometimes I take out some of the minor levels that I might watch intraday, that sort of thing. So the main areas down here is probably going to be into 85, 84.80. Again, that may be a bit close to the price at the moment. So on any big news, that probably won't stand up to much. Then we've got the 255 moving average converging here around 84.30. That's just above another. It's quite a big zone, but I've taken it in parts. We've got 84.20 down to 84, then probably 84 to 83, 80, 85, then another section down to sort of 83, 65, 70. So a fairly wide zone there to look at. I would be looking at picking up dips on a disappointment. I'm hoping it doesn't go down as far as that. Otherwise, that'll put my position under pressure anyway. But if we get a decent dip down towards this zone here, I'm going to be looking at maybe adding to the position, putting a bit more in the pot, sticking it in the drawer and seeing what happens thereafter. But yeah, basically, just to repeat, what I'm looking for here is where I've got the greater conviction for a trade. A break might be better in euro sterling than it might be in euro dollar. I'm in a position, so I'm looking to manage that, and I don't need to rush into anything. Again, for anyone who's not in a position, look at reacting, testing the levels, looking for the stretch points in the moves, to try a quick counter trade, a counter scalp, or seeing if any breaks are holding, they get retested and held, then that gives you an idea to maybe get in a trade. So Kate, you got anything on that?
Yeah, well,
Euro sterling or same boat as
yeah, we're in the
Euro
same
dollar,
boat, but
or even the crosses.
yeah, perhaps a little less the longer term already. I've been trying to buy it this 84, 80, 85, 10 zone. Sorry, did it a couple of times. Also, let some go every time we went up into the 85, 60 to 80 zone. And so as a result, my average is pretty cool, well under 85. Well, actually, well under 85 on the rest. I'm only in a small position right now. I'll monitor it at 84, 80, 86. I'm ready to buy a break as well on top and see how the ECB pans out, whether it's another buy on dips or we wait for a little bit. But fully agree. I think the ECB versus BOE, that's going to be could be the play of the summer, even if BOE puts another 50 BPs in there. We know Bailey is shit scared of killing the economy, and with some good reason to be. I think there's a lot of reasons to be a bit negative sterling right now. We also see it on the cable, but that's not the subject perhaps now.
Yeah, yeah, and funny enough, there was a note out from the British Chamber of Commerce, who are pessimistic at the best of times. They see 10% inflation coming at the end of the year, and the economy, stagnating into that area too. So
yeah,
the news keeps coming for the UK that's pretty negative.
Yeah,
but they're in the same boat as everyone else. They've got to fight inflation and manage it against the economy.
Yeah, and the thing is, which I would like just to remind here, it's not while inflation is flying and a central bank is raising rates. We had a good example about the RBA again this week. It's not while they raise rates that the currency is going to fly, because if your inflation flies and you still raise rates, but your economy suffers and your real interest rates stay low, that is not supportive for a currency on a fundamental basis. I'm just want to add. I mean, technically, if levels break, but on a fundamental basis, it's not while your inflation flies and you raise rates that your currency is going to go higher per se.
And in some senses, it's a zero-sum game because every central bank's in the same boat. And that's what's gonna drive the trends going forward. It's not going to be about how well each country does. It's going to be about who's going to be the least crap. So if you're looking at a list of countries who are going to get themselves through this without too much pain, at the moment you'd have to put the US at the top. The data is still coming out fairly robust compared to others. On the other side, you look at the UK, it's probably somewhere down the bottom because the data's coming out worse. It's all doom and gloom. Inflation's rocketing. So if you put that in trading terms, then you've got to favour the dollar over the pound, and that means you're going to see cable coming lower. So it's whereas before it was who's going to hike first, and that drove the market pricing. Now it's going to be who's going to suffer the least, and they're going to come out top dog. That's going to be where the money flows are going to go. And we could in fact see, stock markets repricing to more normal levels, after all this QE stuff, is finishing. And perhaps stocks might start reflecting the fundamentals of the economy, which is what they used to do 15, 20 years ago. And that's quite funny itself. We may have people in trading now, watching this show, who have, if you're 20 years old, 25 years old, you may not know what the stock market used to be like before the GFC and QE and everything like that. Stocks used to move based on the fundamentals. If a company did well, if the economy was doing well, stocks did well. That all got turned upside down when we came through the GFC. So some of us, old and grey and balding, have seen what it used to be like, and for maybe some of you guys and girls, you're going to learn what it's like in the future. So, I mean, on that basis, just while we look at some other prices, if you folks, I don't know if any of you are still positioned into the ECB, what you're looking for. Gavin said he's looking for 109.60 if the euro gets up there. Let's know what you're looking at. Are you looking to trade it? Do you have a view? Do you think the ECB are going to be hawkish? Are they going to be less hawkish? And what are you looking at? Michael's asked a question. What are your thoughts on Kiwi CAD or Euro CAD?
I did show the Euro CAD yesterday.
Kay, do you want to take that one? I know you look at Euro CAD.
Yeah, I did show it yesterday, Michael.
Do you want to take the screen for that?
I'll take the screen, and I'll go over just, if you don't mind, but very quickly on this Euro CAD, and then talk just 1 minute about what's going on in the yen right now.
Yeah, go ahead, mate. Yeah.
Okay. Euro CAD. Here we go. You see it?
Yep.
Okay, so we go back to the more. This is the shorter term. I was showing this. We got a triple bottom here. 133, call it 90 figure, triple bottom, very important going into the ECB. Other side, I'd say 136, 70, 85, but the bigger zone is this one around here. If it would rebound around 137.5, have a look on what I showed the other day in the longer term. If this 133, if ECB would disappoint, because we know Bank of Canada is really hawkish. If this 133 90 figure goes, I wouldn't be surprised to see 130 in the next weeks or so. That on the Euro CAD. Kiwi CAD, I don't have too much of a feeling, to be honest. The Kiwi and CAD are going to be like who's handling the best their housing market, it seems, because the RBNZ was already talking about it. I think it's now part of their mandate to do something about the housing. But if they want to get housing prices at more reasonable levels, they are going to continue to hike as well. So they might be in the same-ish camp as the Canadians. So I'm not going to. I'm not looking at it at all. To be really fair. So a quick word on
just quickly on the Euro CAD, because the part of Michael's question was related to oil. Would you put a lot of importance on the oil moves right now when you're looking at something like Euro CAD, or is it more the central banks that are going to be the bigger drivers?
Up to now, it's been both, because oil can't stop a potential retracement on oil. Okay, if we get a potential retracement on oils from here, it might of course have an impact on the Canadian dollar. Also, the dollar versus Canada was on a pretty decent level in the low 125s, and that seems to hold right now. But yeah, oil will always have an impact, because a lot is going on the oil side right now, with the Ukraine war, and then OPEC not knowing who wants to or who can produce more or not. So the oil prices are staying high. Canada being an energy and oil exporter, it should still benefit them. But there's always two sides on a currency pair. So today we are going to focus on the euro side of this pair. So watch big level.
I was going to say that, for today, you probably want to discount the oil side for the moment and add it back in after. If you get a hawkish ECB, Euro CAD is obviously going to rise. Then potentially you look at oil. If oil does retreat, that's going to add further. So you've got two potential wins. Blowing bullish for euro on that side of the trade. And the opposite is true if the ECB isn't as hawkish, and if oil keeps gaining. So you've got two factors there. You need to look at which one's pulling at one time and which one's more important at any one time. Today, it's going to be the euro and the ECB. After that, then you can maybe add your oil idea back into it and see what it does there. So, okay, I'll crack on.
Okay, yeah, absolutely. It's all about ECB today, and as I would say, this thing will be in danger, especially if Lagarde kills it again. I mean, if she comes out now, well, don't expect too much. I mean, then this Euro CAD can absolutely collapse, in my opinion. And Gavin says as well, sterling CAD. Yeah, sterling. We're a bit bearish already on the sterling. Overall, so sterling CAD as well might go. Now, just one word on the yen. We have seen yesterday a new high, overnight new high, and then we came back quite a bit this morning on the yen pairs overall. I'm putting up the dollar yen, but put up any yen pair is going to show the same picture. We've gone up in a lot of yen pairs on the technical side, up to the 1618, and it was in a lot of yen pairs. Also, we have already mentioned yesterday and on Face that the yen was moving out of sync with the interest rate differentials. It's a bit like you compare it with those acrobatic airplanes, those light airplanes. They go like climb up, and that's the model funds and the momentum funds. They still need to buy, and then all of a sudden the engine sputters because there's not enough oxygen to keep the stuff going. And now we are correcting this. We are trying to come back more in line with the fundamentals. Let's put it that way. I think yesterday was a little bit of an overrun, a push for a little too much, and we spotted it in the room. Several of us were like, well, people were actually going short. I took my profits on all my yen shorts yesterday because we were starting to move a little bit out of sync. I'm not saying this is reversing though. I mean, the next week will be huge for the yen because we will hear from the Bank of Japan as well. I would even say it's still worth looking to buy the dip, and you see a big level here. If we could get another 150, 200 points, then we will have a kind of the similar situation that we saw the first time around from 131.5 down to 127. All of this is possible to come back in line with those yield differentials. That's just what I wanted to say on the yen. So be a bit careful. Don't get too much sucked in on either side right now, I would say. Yeah, good stuff, mate. I mean, I've got pretty much the same view up there. It looked like last night was a barrier flush of those 134.50s. What did the high get to? 134, a little above 134.5. So they took out the 134.5 as well.
Yeah. So aside from the ECB, on the data front from the US, it's pretty quiet. We've got the jobless claims. It's about the only number there. Just another one to keep an eye on, one of the weekly datas to look at there. Obviously, a lot of the focus of trading is going to be around the ECB. So I'm not potentially looking at much else bar what I get into that and managing what I've got. Just have a look, see if there's any other questions quickly before we finish up for the day. Precious metals. Kay, do you want to, while you've got the screen, do you want to click that one up?
Sure.
Go have a quick look at gold and silver.
Range. We're trying. We held this support zone. We are holding it. We are turning around this trend line, just hovering above the 200 DMA. I'm going to repeat once more. I don't particularly fancy MAs in FX, but I think in stuff like precious metals, oil, and stocks, they have a lot more to say. So I think we're in a range here. Gold is 18, call it 1830, 1870, 75, and I would gladly be trading that range for now. Same thing about silver. We're trying to move away from it several times, and we're bang on the 22. It's an equilibrium level. I would respect it, and keep an eye out on 2190. If it goes back down again, we could do another another 0.5%, and then I would start to look at 2170, but especially on the 2140, I would say. That's going to be an important one. And here we can see this is even on the 4 hours, but how the 200 moving average has been capping it in the past few days. So I think moving averages are a little bit more important than on other stuff than on the FX pairs. So top side 22.5 again. There's no. To me, it's in a range right now. When we wait for actually economic data on those stuff. If the reopenings in China go better than expected, if the rest of the world growth can hold up a little bit better than the worst fears, this one could take off again, because it's an industrial metal. So don't forget it. If the economy does well, silver should do well. And that's it.
Yeah, cool, mate. Just a note from Gavin there, that gas dumped hard yesterday. Yeah, there was an incident at a US refinery, potential fire there. It wasn't as bad as expected, but some might think you get an incident like that, you'd see the price jump. But in the case of this, because the gas was due for export, if it was shut down or if they couldn't get those exports out, it would have gone into the US supply. Which that's why we saw a big dump, hard dump in that gas there, purely on that incident. So I think that might be the move you're referring to there, Gavin. Okay, folks, I think we've kept you long enough. I'm sure you've got plenty to do in the hour and 15 minutes before the big event. As always, thank you very much for coming and watching the show. Please do check out the ForexAnalytix trading platform. Always happy to see you guys and girls in there, and also check out the the ForexAnalytix Traders Funding Program, which, as you guys have spoken about earlier, for those who have taken it or looking to take it. Once again, the best of luck to you. Good luck today. Stay safe amongst all. Don't get caught out in anything silly. If you're not sure, sit on your hands, ride the event out, get over the volatility, and look at it later on or tomorrow when things have calmed down. Trade well. Hope you make lots of pips. I hope to hear some good stories tomorrow when we have the show. And thank you very much. See you tomorrow.
Yeah, have a good day, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.